This trading strategy I'm about to show you turned me into a consistent, profitable trader. And the best part? It is simple, works in almost every single market, and it takes less than 30 minutes from start to finish. Let's get straight into it. A common mistake I see among beginner traders is trying to catch the exact top or bottom of every move. Sure, it feels great when it works, but you don't need to catch the whole move to make money in trading. In this strategy, our goal is simple: capture small, consistent pieces of a trend. And it all starts with rule number 1, which is to determine if the market is trending. Here's how to spot a trend. An uptrend happens when the price makes higher highs and higher lows. A downtrend happens when the price makes lower highs and lower lows. We only trade when there's a clear direction, not when the price is moving sideways or choppy. Once you've spotted a clear direction, we move to the next step, and this one filters out 80% of bad trades. Now that you've identified the trend visually, let's add a simple confirmation. We're going to use the 200 EMA, one of the most reliable indicators for spotting trend direction. Here's how to add it. On TradingView, click on Indicators, search for Moving Average Exponential, and add it to your chart. Go to Settings, Inputs, change the length to 200, and click OK. Now, here's how we use it. If the price is above the 200 EMA line, we only look for buy or long positions. And if the price is below the 200 EMA, we only look for sell or short positions. This keeps you trading with the trend, not against it. And trust me, that one filter alone will save you from a ton of fake setups. Now that you know the trend and you've confirmed it with the 200 EMA, it's time to pinpoint your entry using one of my favorite tools, the MACD indicator. To add it, go to the Indicators tab, search for MACD, and add it to your chart. You don't need to change any settings. The default setup works perfectly for this strategy. Now, here's a quick breakdown of how it works. The MACD, Moving Average Convergence Divergence, tracks the relationship between two moving averages to show trend momentum and potential buy or sell signals. It's made up of 4 components. The MACD line, which is the blue line, a faster moving average, usually 12 period. The signal line, which is the orange line, a slower moving average, usually 26 period. Next, we have the histogram, which shows the difference between the two lines. It helps visualize momentum. And finally, the zero line, the midpoint that separates bullish and bearish momentum. What we're looking for here is a MACD crossover. When the MACD line crosses above the signal line, it's a bullish signal. When the MACD line crosses below the signal line, it's a bearish signal. Those might sound like a lot, but don't worry. Once you see it in action, it will all click. So let's jump into a real chart and I'll show you exactly how to apply this step by step from spotting the trend to taking the entry. Price is forming higher highs and higher lows, so we can clearly see that we're in an uptrend. The price is above the 200 EMA, which means we're only looking for buy or long positions. Now for rule number 3, the MACD confirmation. We spot a bullish MACD crossover happening below the zero line. That's our signal to enter a trade. We take a long position, place the stop loss just below the recent swing low, and set our take profit at 2 times the stop loss distance. That's a 2R setup. Now, let's look at another example. Again, price is printing higher highs and higher lows, so we're still in an uptrend. Price is above the 200 EMA, confirming we're only interested in long positions. Then we spot a bullish MACD crossover. But notice, it's happening above the zero line. That's a red flag. According to our rules, we only take longs when the MACD crossover happens below the zero line, so we skip this one and wait. A bit later, another bullish crossover appears, and this time it's below the zero line. Perfect setup. All conditions align, so we enter long, set the stop loss below the recent low, and aim for a 2R take profit. So, as you can see, the strategy worked exactly the way we wanted it to, but we can still make this strategy even better by adding one more confirmation to take this setup to the next level, something that filters out fake signals. We simply add a 20 EMA to the chart and watch how the price reacts around that line. This becomes our final confirmation. It's super simple. When the price is above the 20 EMA line, it confirms an uptrend. When the price is below the 20 exponential moving average, it confirms a downtrend. Now, let me show you one of my recent trades and walk you through all 4 rules step by step. Price is forming lower highs and lower lows, which means we're clearly in a downtrend. Price is also below the 200 EMA, so we're only looking for short setups. Next, the MACD shows a bearish crossover above the 0 line. That's our third confirmation to look for sells. And finally, a candle closes below the 20 EMA, showing sellers are gaining strength. That's our entry signal. So I took a short position, placed my stop loss just above the recent high, and targeted 2 times my risk for take profit. A clean, confident 2R trade. So now you've got a strategy that's simple, powerful, and repeatable, even if you're just getting started. By the way, if you're a crypto trader, I've dropped my Blowfin link in the description. That's the exchange I personally use, and they're offering some great bonuses for crypto traders right now. Check it out, and I'll see you in the next video.